What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guests in this episode of Hidden Forces are Andy Constan and Mike Green. Andy is the founder and proprietor of Damp Spring Advisors, and Mike is the portfolio manager and chief strategist at Simplify Asset Management. Both have been on the podcast before, but this is the first time that they are appearing anywhere in conversation together. I've included links to their past appearances, as well as those of previous guests that are relevant to today's conversation in the related tab to this week's episode page at hiddenforces.io. Today's conversation was recorded on Friday, October 6th, after a week of turmoil in the bond market that saw dramatic repricing of long-term government debt, significantly raising debt servicing costs for the U.S. government and sending yields on the 10-year bond to nearly 5%. We spend the first hour of our conversation today trying to make sense of this latest move, as well as understanding the implications of these higher rates for the economy and asset markets. The second hour is dedicated to discussing the risk-reward calculus for investors who are trying to decide whether or not they want to use this opportunity to add bonds to their portfolio, in what amount, over what duration, and what the risks and opportunities are of doing so, given the continued uncertainty about the direction of interest rates and inflation. If you want access to that part of the conversation, and you're not already subscribed to Hidden Forces, you can join our premium feed and listen to the second hour of today's episode by going to hiddenforces.io/subscribe. All of our content tiers give you access to our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. Lastly, because this conversation deals with investing, I want to make absolutely clear that nothing I say on this episode can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this incredibly educational and timely conversation with my guests, Andy Constan and Mike Green. Andy Constan and Mike Green, welcome back to Hidden Forces.
Thanks, Demetri.
Thank you, Demetri.
So this is the first time that you guys are both on a podcast together. Do I have that right?
Yep.
Yeah.
It's a great day to have you both on because we're recording this on Friday, October 6th, and we just got the new payroll numbers, and they, I think, were twice the number the street was expecting. Before we get into the conversation that I had planned for today, I'm just curious to hear what your thoughts are on these latest numbers, how the market responded, and the significance of it. Andy, why don't you go first?
Sure. So I don't really do much to predict or extrapolate from any particular single number. So my observations are general, and that is the employment picture remains hotter than the Fed wants. And that means that there is continued pressure on the Fed and others to rein in this economy a bit. And digging into the specific numbers, obviously the headline number was very, very hot. And we've done a lot of work here at Damp Spring on the average hourly earnings, and it was cool, but also reflective of the demographics of a service economy in which any job increases tend to lower the average earnings because of the distribution of labor toward lower paid service-oriented economy jobs. And so, that tells me that the service industry remains, the service sector, which is most of our economy, remains fairly strong.
Well, that was going to be my next question. Well, that was going to be a follow-up question. I want to hear what Mike has to say, but my question was also going to be what do we know about the quality of these jobs, and how is that relevant? I mean, is that in some sense a kind of an indication that this jobs report is a bit of a head fake if the quality of jobs that we're adding isn't all that great? But You can feel free to add to that if you want, Andy. And then Michael, I'd love to hear what you have to say about that.
So I think the story is the service economy is the thing that needs to be cooled, and the service economy reflected in these numbers was strong. And so it's not about quality. In fact, at the peak of labor tightness, you almost always get significantly lower productivity as the marginal worker is less skilled and higher paid.
So I would emphasize some of the same things that Andy just highlighted, right? I mean, that absolutely is true. We've seen this in the past 3 recessions now, almost 4 to be totally accurate, but where productivity, which historically would fall during recessions as production would fall, increasingly we actually have a dynamic where many of the things like services, it's not as clear that there's actually a demand destruction that occurs as much as there is a weaning of relatively unproductive components of labor. And so in the 90 recession, the 2000 recession, the 2008 recession, and the 2020 recession, we saw productivity rise significantly around recessions as we cut out workers that I would describe as kind of nice to have, but not necessary to have for most production. If I'm looking at this report, unfortunately, I come to the same conclusion that I've struggled with all year, which is it seems like this is a very low quality data report. We receive very different information from the household survey than we did from the payrolls component. That often reflects elements of individuals moving from self-employment or gig type of employment into more formal employment relationships as they prepare or hunker down in advance of a recession. But, just to hit the quality component directly, we've had quite a bit of full-time employment decrease in the past several payroll reports. That's really kind of going to be the real question. I think Andy's right. When you think about service economy, it really matters. Are you suddenly able, because of increased immigration, to hire people to clean, dirty hotel rooms and bedpans and everything else? It seems like the answer to that is yes. And so we're filling in those areas. But the overall numbers, the hourly numbers, the full-time jobs, the level of labor force participation amongst those with a college degree, this was not a great report. And I think you actually see that in the market reaction to it, which is, oh my gosh, is the Fed going to be led astray by this data, just like much of the data has been relatively low quality going throughout the year.
So the last few years has been a challenging environment to try and forecast where economic activity was going to go, where interest rates were going to end up, and when inflation was going to begin to cool, and how high it might persist at current levels. Mike, I'm pretty sure, you've been on the show before multiple times. Listeners know that. Andy's been on the show before as well. And if I remember correctly from when we did our event together in New York, the Simplify event, asset management event, I think that the Fed funds rate was around 3% at the time. I think long-term Treasury yields were kind of near there as well. And I think that whole summer, pretty much, you were making the case that the Fed had already over-tightened. Is that correct or no?
Yeah, no, that's my view is that the Fed should have stopped at around 3%, and that it ran the risk of over-tightening, which I believe it has actually done. And the problem is, of course, how long and variable are the lags that stem from that over-tightening approach. And I think one of the things that has been very clear, and others have pointed to this, is that the dynamic of short-term floating rate borrowing that was so common prior to the global financial crisis, and this is in particular tied to what's called the commercial paper market, that has been reduced. And so a lot of the sensitivity to short-term interest rates is relatively slow. But this is far from unique, right? We had the same dynamic of an extended period of hiking in the 2004 to 2008 time period, in which there were similar debates around, is it effective? Can the Fed actually tighten? What is the implications associated with this? Is the Fed being too, stable in its 25 basis points over and over and over again? Does that cause very different outcomes? And, I would just argue that we're actually having those same debates all over again. The difference is this time we've had very different impulses that have actually hit the market from the stimulus side. And so, things candidly that I didn't fully appreciate or that I hadn't anticipated would be the extent of the ERC fraud, for example, that has existed. Certainly didn't anticipate the fact that oil prices would fall as sharply as they did in the aftermath of the Russian invasion of Ukraine. that created a lot of additional buying power, at least as an impulse. And kind of the last thing that I did anticipate that I think is actually helping to mislead some of this stuff is actually the relative rigidity associated with portfolio allocations and the lack of unemployment increase tied to very low rates of growth in the labor force. We've experienced very low rates of labor force growth. That makes it difficult for unemployment to pick up in a sustainable way. That tightness, I think, has generally contributed to the cycle being extended. But, it is fascinating if we go back and we look at the first 2 quarters of 2022, we had a contraction in economic product, right? GDP fell. And so until something actually changed in the aftermath of that, and I would point to the decline in crude oil prices and the increased stimulus around ERC as primary drivers, it looked very much like we were headed into a recession. Now the question for me becomes, have we tightened to the point that there effectively is no escape for a growing segment of society, right? Does that create conditions under which we encounter a hard stop as compared to a slowing? And that, unfortunately, feels like the direction that things are going.
Andy, I'd love to hear your thoughts on what Mike had to say, because you have been on the opposite end of the spectrum. You're, I think, best known for the phrase higher for longer. Your view was that the Fed would be able to go higher for longer. And in fact, we are at levels that I think a lot of analysts would never have expected. So what is your view in terms of where we are today? And as far as the question of, has the Fed over tightened, or could it continue to tighten, do you think?
Yeah. So I guess the first thing that, even going back to a year and a half ago, when the year and a quarter ago, when the tightening started, I had already called 6 months prior the QT effect and how that was going to be an effective tightening. And the market sold off on that. And then the tightening phase began. And I got to tell you, I was a bit disappointed that the Fed decided to, basically until now, really not address the thing that I think makes the difference in this economy, given many of the things Mike just said about its sensitivity to short-term interest rates, to focus on hiking short-term rates. So while I've always been higher for longer, it's because I thought certain things have to play out in a certain way so that the economy actually slows. I think the Fed continues to focus on the wrong thing and has hiked rates. Is 5.25%, 5.5%, 5.75%, 6 the right rate? Is that over tight? Honestly, I don't know, because I think, frankly, that rate doesn't matter much.
You're saying they should have been focused on contracting the balance sheet more?
Yeah. So I've been saying that they should, firstly, the mortgage runoff has been anemic at best, well below target. And that's partly because they hiked so much and mortgage refinancing is no longer available. And so their mortgage portfolio remains, heavily long duration. In fact, its duration has actually grown because the mortgages they own have extended. And so I've been calling for them to increase QT for a long time, really back into January. And what turns out, and I missed this in the first 6 months of the year, what turns out is the impact of the debt ceiling on issuance, and issuance being the principal transmission mechanism of quantitative tightening through runoff, has resulted in 6 months, almost practically 9 months, if you go back to the lows of last September, of strong asset performance.
Because the reduction in anticipated supply had a dampening effect on bond yields.
It kept bond prices high. It created significant negative term premiums in bonds, which indicate, bonds are in short supply or in high demand. Now, they weren't in high demand. We know the banks were selling until they were able to borrow against the BTFP. And we know foreign central banks have been, by and large, letting their portfolio run off as well. And we also know that, there wasn't a huge demand impulse, but there was a lack of supply impulse that lasted really from, call it November to July. And that all changed. And I think now the impact of significant duration issuance is resulting in the asset market correcting, and that will be effective. And so QT is being transmitted. I think there's more for that to go. And that Now we're starting to see the slowing. Now we're starting to see the actual tightening in financial conditions, while raising interest rates really had no impact on the long end of the curve. It just created more and more and more inversion without actually having an economic consequence. The point of raising interest rates, if no one borrows in short-term interest rates, which by and large, even today, very few people do, you get no impact unless long-term interest rates start to elevate at the place where people borrow. And that just didn't happen because there was no supply to push that to a sensible level relative, and the curve just continued to invert. And I think that's where a lot of people miss that inversion signal, is they didn't realize that the inversion has to be followed by a bear steepening for the tightening to play out.
I think that we both ended up getting a portion of last year wrong, primarily around this dynamic of supply. And Andy, of course, has pivoted and been far smarter about the supply dynamics on a year-to-date basis. I have actually been candidly surprised by the rigidity of the demand response to the increase in supply that's emerged in the last couple of months, which I agree with Andy is actually really hitting where we are. The difference, I think, is because the Fed has hiked so much at the front end, without contributing or more aggressively tightening through quantitative tightening, we haven't seen risk asset spreads widen, right? And so among other things that we're seeing, for example, is junk bond issuance has effectively slowed to a crawl because the companies themselves cannot actually refinance. That means that the refinancing wall is moving rapidly towards us in a very meaningful way. The duration or the maturity of the high yield index is now below 5 years for the first time in history. That's telling you that there is a large wall of companies that absolutely need to refinance in the next 2 years. And the current level of interest rates is so punitive for them that they're doing everything they can to desperately hold on for the idea of a Fed put, meaning the Fed is going to start cutting rates. They want to be the player that is last to issue effectively in this. But if Andy is correct and we have a higher for longer, and I sympathize with that call, certainly more today than I did a year ago, we're looking at a situation in which we actually start to enter into a much more disorderly event, right? So part of what I would argue that we're seeing in the demand side or on the supply side of bonds is the limits of markets to actually adjust to increases in supply when demand is relatively rigid. This has been a lot of the work that I've been focused on recently. And I think, Andy, you had a great comment on Twitter, which was, the demand side of the equation moves very slowly. 401k allocations have to change. Institutional investment committees have to sit down and start debating, do we actually want to allocate to private assets? Do we want to allocate to public assets? Do we want to buy bonds? Do we want to buy equities? And the more they run a fixed allocation schema, perversely, the more asset prices are determined, right? So that becomes an inelastic demand response. The more prices are actually determined by the supply factors that Andy is actually hitting on. And so in a very weird way, the Treasury has had much greater control around the individual components of the curve in many ways than the Fed, because the Fed is simply hiking the front end of the curve, right? In perverse ways, that's raising demand to hold cash. But it hasn't yet led people to meaningfully, and we are seeing this on the retail side, but it hasn't yet led anyone to meaningfully say, man, why am I holding equities? I should probably be getting out of my equities and buying bonds. And we're just not seeing that much evidence of that yet, despite the fact that many institutions could actually fully roll into various fixed income investments at this point and meet most of their objectives.
So, Andy, I think in our last conversation together, we were discussing the Treasury's decision to issue more short-term bonds in order to fill the TGA, the Treasury General Account, at the expense of long-term bonds. I'm curious if you can add on to your answer what the market's expectation is around issuance going forward, and also what is going to be the duration of that issuance, and how do you expect that to affect yields in the bond market?
Right. So even before quantitative tightening, the moment quantitative tightening's actual plan was announced, I made the observation, it must have been in April 2022, that the Fed had ceded the transmission mechanism of quantitative tightening to the Treasury. And so it's been in Janet's hands forever now, literally since the program was announced. all that matters is what she issues, because she's paying back the Fed based on bonds that are running off. The Fed's not selling any bonds. So in order for the transmission mechanism to occur, if she chooses bills, that mutes the transmission mechanism. And if she chooses long-term duration bonds, that enhances the transmission mechanism, because those are the bonds that are actually getting sold. And so that dynamic has been the entire dynamic now. And frankly, I think it has driven all asset markets since December 2021, when the program was announced, and all this stuff around growth, inflation really didn't matter. All you really needed to understand was the forward outlook for how Janet was going to pull on her levers. The lever got taken out of even her hands by the debt ceiling in December, and it got put back into her hands with a TGA that was approaching zero. And when that happens, you got to get some money. And to do that, you got to issue some bills. And that's what she did. And so now she's in this circumstance where by year end, she'll have issued 22% of all government bond held by public in bills, which is an extremely large share relative to bonds. And over, decades of that number tends to be worked down through time. So how do you work it down? You issue more bonds than bills. So now you have to project what you think issuance is going to be, and that has two factors. Three actually. One that is probably not relevant anymore. The first factor is, what's the budget deficit? And so that's big. Let's call it $400 billion a quarter. Maybe it's bigger. Who knows? It's probably not smaller. And then you've got quantitative tightening. She's got to pay back the Fed $180 billion a quarter. So that's what, $580 billion. So the interest is in the budget deficit number, 400. So that's 180. So now you got 580 billion. And then the question is, are they increasing or decreasing the Treasury general account? I think they're trying to settle around $750 billion for that account, which they should achieve by year end. And at that point, then you'll have wiggles around that number as, the normal things like tax income and expenditures go out. But by and large, that number will stay fairly stable. And so you've got a sort of projected quarterly issuance of $580 billion to fund, each quarter for the next forever. I don't know when the deficit's going to come down, but, you got that going. And the runoff has a long way to go, at least 2 years before the reserves plus the RRP are back to, say, 10% of GDP, which is the target number that Waller particularly announced, but then has been supported by Williams and Powell. So, that's a long time for this $720 billion a year, $60 billion a month, and $180 billion a quarter to generate issuance. And then you have the deficit. So at $580 billion, to get back down from 22% bills to below 20, which is where they'd like to live, you have to issue less than 20% of bills at some point. Next quarter, they're issuing, I think my math's right, 60% bills. Now that's also a shitload of bonds. So that means that bills are going up as a proportion, since they're at 60 this coming quarter. Next quarter, you've got this 580 billion slug, let's just say, of issuance. Is it going to be 20%? Because at that point, you make no progress. Or is it going to be less? Now, if it's 20%, that leaves 80%, or about 450 billion bonds, which is 120 billion more bonds than this coming quarter. So if you project that and say they're just going to stabilize at this new 22% bills outstanding with a $580 billion nut to cover each quarter, you're going to have year over year over year, or quarter over quarter, of 450 billion of duration. And that's a shitload.
I mean, this might, a quick question that I want to hear Mike's interjection here. Just looking at the political landscape, looking at the proximity of the 2024 elections, how does that impact your analysis in terms of how many bills the Treasury is willing to issue at the expense of securing long-term funding, because they're concerned about driving the long-term rates up too high before the November election?
So I'm not really a political speculator. The government has limited ways of increasing spending, given to call it gridlock is kind in the legislative and executive branch. So there's not a spending lever that can work. If it was a three-pronged House or, legislature and executive branch, maybe you could get a spending bill. So that's not there. So then the only other thing is financial markets, and, the levers that Janet can pull are reducing bond issuance or spending the TGA, because that means that the $580 billion of deficit that you need to fund, you can decide in, say, May to not issue at all. And what happens? Your TGA goes from 750 to 250, and, okay, fine, no problem. But the markets roar on that sort of thing. So those are the levers. I don't know which one she's going to pull, but she's going to tell us every quarter which one she's pulling. And so I'm just going to pay attention to what she says. My expectation is if they do need to juice the economy, it's going to come in May when it matters, not in November this year or February next year when it doesn't matter.
For listeners who are listening here, we keep mentioning the TGA, which we said earlier was the Treasury General Account. It's basically the savings account for the government. So, Mike, why don't you go ahead, respond, and then I have a bunch more questions out here that I want to ask you guys.
Sure. So first of all, I think what Andy is actually hitting on is really the really critical thing. And I think he said something that was really important, right? It turned out that none of the debate around inflation, growth, et cetera, any of that ultimately mattered. And I think that unfortunately is where the vast majority of the discussion has actually occurred. The technicals of the market in terms of the ability to absorb the supply, whether that's an increase or a decrease, I think is really what Andy is focused on. I think that's actually been really, really smart. But the discussion often takes the form of, well, we've entered into a new secular inflation period, or growth is booming and therefore, right? And most of those narratives ultimately are not, as Andy points out, one, relevant, and two, actually true, right? The economy has meaningfully decelerated. We've seen a very aggressive retreat of inflation. If we use metrics that are market-based as compared to imputed, we're actually already below the Fed's target on inflation. And so, we're kind of trapped in this mode where it's like the Fed, by and large, has actually achieved what it's trying to achieve. And now it becomes this interesting question of what are the unintended consequences of the actions that have ultimately occurred? And I think that's going to be, to me, the most interesting part of the discussion with Andy that hopefully we can talk about as we move forward on this. But the dynamics of identifying the inelastic response to the changes in supply, phenomenal. And I have to hand it to Andy, because part of the point that he's making is when you have a ton of money coming in, or a ton of supply, coming into the duration markets, for example, on a vol-adjusted basis, that requires people to place bets, right? When you're dealing with a 30-year bond, for example, that is somewhere in the neighborhood of an 8 to 9 vol instrument, whereas the front end, the bill, has effectively no volatility associated with it. When you deeply invert the curve, you make it much less attractive to finance that. So even if you could obtain financing economically to add leverage to a bond position, if you thought it was the right thing to do, it's more expensive when the curve is deeply inverted in the way that it's described, right? That lowers demand. And so perversely, by aggressively hiking at the front end of the curve and not working the quantitative tightening side, we haven't actually seen the curve steepen as you would hope to see, an increased cost of capital for longer term financing that would slow things like housing, that would slow things like factory construction, that would slow things in the economy that traditionally we would associate with inflationary conditions. I think Andy's been 100% correct that by focusing on the front end of the curve, what we've done is unfortunately raise the risk that at some point, like we've built up a dam that can effectively break at some point, right? Where people suddenly discover that they are in much worse financial shape than they would think, because the realities of that much higher cost of financing have not meaningfully hit for them in any meaningful way. So I think that is actually kind of the most important thing to address on that. And I think the other component of it is that when the Treasury actually announces, and this is, perversely the extreme version of don't fight the Fed, the Treasury announces under the QRS exactly what it's going to be financing. It gives that information out there. Andy has been brilliant in terms of focusing on exactly that underlying dynamic. But perversely, because it's not conditional, right, we enter into a situation in which, the Treasury is kind of the dumbest participant in the market and yet is the one driving the actual bus, right? The desire to get below 20% could very well lead to the Treasury locking in extremely unfavorable rates of financing that ultimately, have to be thought of in an integrated fashion as market participants. And I emphasize that phrase integrated, because anytime you do something like a discounted cash flow analysis, what you're actually trying to do is establish a fair value for dollars received in the future between risk-free assets, risky assets, equities, bonds, etc. You're ultimately trying to unify the price of that dollar across time and space. And the evidence that people are actually doing that is very low. That, to me, is, again, the most interesting thing that comes out of this, is that faced with a dramatic change in the cost of obtaining dollars, real dollars, we can see this in tips, 30 years off into the future. If I go back to, 18 months ago, it would have cost me somewhere in the neighborhood of $1,200 to preserve $1,000 worth of purchasing power 30 years off into the future. Today, that number is, $520, right? So that should change the way people think about almost every asset out there. And yet that degree of self-reflection or consideration appears to be notably absent.
Yeah, I think that's a matter of time, to be honest. I think you have.
I agree with you.
I think you've have, and this is the way my script that I wrote in July, it plays out. First we had to get the bear steepening, and we've gotten a pretty major bear steepening. We're almost 90 basis points, well, maybe over 90 basis points higher in long-term bond yields in the last 2 months. And so now you have the process of term premium arbitrage as the bond market has cheapened, both in a yield sense and more relevantly in a term premium sense. Everything else looks more expensive. It just takes time. And, the forces of portfolio reallocation don't happen overnight. I mean, you had the front running of quantitative tightening, which was a clear sign that the financial conditions were going to fall. And you had lots of rallies in the first half of 2022 and even the summer of 2022 before people finally got the message. So I think it's a matter of time. And so what I would think is there's a level. Now, there's still a lot of pressure on long-term bonds as this thing I mentioned about, increasing bonds to get the bills percentage down. So it's not obvious that bonds are super cheap, but they certainly are relative to equities. And so that portfolio shift, I think, takes 3 to 6 months. And I think we're just at the start of it. One point on Mike's long-term financing of the U.S. government point. Remember, I said $400 billion of bonds being issued a quarter. Let's say that's a lot, and it really should be $200 billion, and they should let bills stay high. Or even zero. They should just issue bills, but because interest rates are likely going to fall. Now, the Treasury isn't a market timer, but we're really only talking about $1.6 trillion out of a $30 trillion federal debt that would be refinanced at higher rates. And so I think the Treasury, absent the political issues that we spoke about, is highly incented to kill inflation so that the Fed can cut, so that their cost of debt can go down. And throwing an extra whatever it is, $1 trillion or $2 trillion of bonds at relatively high yields seems like a very, very low cost to create the sort of pressure that brings interest rates down to 3% for longer.
So let me see. I want to try and extrapolate or highlight some of the things that were just said. So the thing that you just commented on, Andy, was, I think, Mike's second point, which had to do with, again, something that you also brought up again, Andy, in the early part of the conversation, which was the Fed's focus on adjusting short-term rates, the Fed funds rate upwards, instead of focusing on tightening the balance sheet, which disproportionately inverted the curve and sort of made it so that when the dam eventually breaks and long-term yields begin to rise, we could have a sudden readjustment and the effects on the economy. So I guess my question there is, what are the potential effects on the economy of this rapid readjustment of long-term rates higher? I'm wondering what your guys' view is on that.
So, firstly, I think the Fed announced quantitative tightening at a sizable level and has implemented quantitative tightening, and that the problem with it was not the Fed who wasn't using a lever. They were using the lever. It's just Janet muted it.
The Treasury. It was the Treasury.
Yeah. So let's start with that. I think the Fed's going about it right. They just got screwed by, the muting of both the debt ceiling, which was out of Janet's hands, and then the last 3 months of TGA rebuild. But now we're back in place, and both of these factors are impacting prices. But let's talk about an inflationary cycle in which Fed tightens without something breaking, meaning a non-credit event slowdown. Now, ultimately, credit events happen when the recession that follows occurs. But in past, certainly in the last 40 years, when there's been an increase in interest rates, something's broken.
A quick question. Why was SVB, why was not the regional bank crisis that we had in March not an example of something breaking? Or why did the market decide that it doesn't
It's just too small. Those are,
because of the lack of contagion.
Yeah, lack of contagion. It helped the bigger banks instead of hurt them.
And just to interject for 1 second. So I agree actually with exactly that observation. Money flowed into JP Morgan, not out, right? That's really critical in that component. The second is remember that the actual underlying dynamics of that event, and I think this has broadly been underreported, it's not really that Silicon Valley Bank did such a terrible job of managing its duration exposure relative to peers, right? This is part of the point that I've emphasized repeatedly. Losses across the banking system are really dramatic. Silicon Valley Bank, unfortunately, was really exposed to the dynamics of a traditional bank run, which is really what happened there. You actually had a very concentrated depositor base. The guidance from the OCC was to think about the duration of your depositor base as being relatively stable. In the case of both SVB, where there was some question about the credit quality underpinning things like their venture capital lending, that was a radically different experience for somebody like First Republic, who had super high quality debt, but ultimately faced a run on deposits in exactly the same manner. Right?
Yeah, no doubt about it. No doubt about it. I agree completely. This was about deposit flight, not about, a huge difference. I do think there was a pretty big difference between the debt management policies of, say, the ones that went under versus something like M&T Bank, which actually actively didn't buy some of the low coupon bonds they were essentially seeing as with massive deposit inflows. But that's sort of a lower level point. The higher level point, no contagion. And so the question is, in a non-led by something breaking, what creates a slowing economy? And the answer to that is very simple: demand destruction. And demand destruction happens with two drivers, one very direct and one less direct. The one that's direct, job losses. We haven't seen that. The one that's indirect, asset price declines, which has a wealth effect impact. And whether that's your home or your stock portfolio, your 401k, those are the things that matter and the wealth effect. And so the wealth effect's been basically absent until 2 months ago. We had very strong portfolio performance since the bottom. And so now the wealth effect's under threat. And so the first thing that happens when the wealth effect happens is you get some demand destruction, which should, at some point, though this quarter is going to be gangbusters GDP, should at some point impact earnings growth expectations, which would be my Act 4 when, after equities have caught up to the big sell-off in bonds by becoming cheaper, you get also demand destruction on earnings expectations, which leads companies to actually fire people instead of hoarding workers. And, people then will say, well, it's not the big corporations that employ everybody. That's by and large true. But all the companies that don't employ the rest of us, all those small companies are service-oriented companies, and they're not going to fire workers until they start to see demand destruction from their other clients, their customers. And so my basic picture is that we have to see demand destruction. We have to see that first by the wealth effect channel, before we start to see negative earnings, before we then see real layoffs, and then we get the recession. And so I think we're just early in that process.
So a follow-up to my original question about the economy, how important, so you mentioned the wealth effect. How important is it that something that both of you guys, I think, commented on early, so many people had locked in long-term interest rates on their home mortgages so that the housing market channel hasn't been as affected as some people expected? And then also, in addition to answering that question, I just want you guys to also, whether it's Mike or Andy, somewhat to just clarify more specifically. I mean, you touched on earlier the way that equities are discounted against the yield on bonds, but just explain a little bit more or be more direct so people understand why there's an expectation that equity prices should adjust lower when the yield on government debt adjusts higher.
Well, I kind of gave my pitch on that, right? That ultimately a dollar in the future has to be equal across, whether it's coming from fixed income or whether it's coming from equities. That's ultimately why we try to discount equities. That's what you're attempting to do. That's the real benefit associated with fixed income, is the guaranteed security that it delivers that into the future. Whereas an equity model is ultimately going to have a stochastic component around that and uncertainty about the ability to deliver that in the future. But none of that really matters if people don't have the flexibility to pick one versus the other, right? And that, I think, is actually, again, really the critical
You're talking
component.
about systematic
right.
allocation.
So if I run a portfolio like a target date fund, where I have an allocation of 75-25 bonds and equities, nowhere in that allocation model does it say, maintain this allocation unless bond yields are this much better than equity, possible returns, right? It assumes that there is no ability to have transparency or knowledge about that future. And this, by the way, is a byproduct of the uncertainty and dismissal of things like strategic asset allocation. I mean, this was the original excitement around things like a Shiller PE, right? Was that it allowed us to take something that we presumed was inherently unforecastable. What is the future return associated with equities? And gave us a model that at least historically had provided a reasonably good guidance about what to expect from equity returns. That model largely failed in the presence of many of the stresses that I try to highlight, things like systematic allocation or a growth in 401k assets. We've seen behavior emerge that really can't be explained by prior history. That's led to, in my opinion, kind of a degree of nihilism that basically says, well, it doesn't really matter. We just backtest, we run a portfolio, and when you see this sort of extreme change, there's no mechanism for a target date fund to start to change its allocation. There's no mechanism. That's very difficult. The institutional hurdles to getting a institutional asset allocator to change their allocation models in the face of this type of extreme move, candidly, is largely untested, right? And I would suggest that we saw the reverse of that in a lot of ways, where people remained allocated to bonds even when they were out offering 0.5% or negative yields.
You broke that down really compellingly in episode 114. I still have the number seared in my head when you were first on Hidden Forces, Mike. So I definitely recommend people check that out. And in fact, it's a good moment to tell people that there's a related section on the podcast page for this episode where I'm going to have all the related podcasts, whether it's this one or one we did with Stephen Kelly on the SVB bank crisis, or Bob Elliott, or Andy's previous episode. So you guys definitely want to check that out. Last question, guys, before we go to, and I want you to feel free to respond to what Mike said, Andy, and then follow up on answering the question I'm about to ask. Before we move into the second hour, I wanted to ask you guys, since we're talking about the effects on the economy, we're talking about various channels by which consumer demand could be affected, where economic growth could be affected. What parts of the economy are most exposed to refinancing costs today that could actually have a meaningful impact on economic growth and earnings?
Yeah, so let me first address the equity jaws. And the equity jaws is described as the equity up, bonds down, which has been what we've been seeing, and those jaws are at their all-time wide. And so, that disputes the idea that both Mike and I agree with, which is higher interest rates are bad for stocks because of the discount rate mechanism. But what we've seen in this higher for longer environment where you have very high nominal GDP is that any increase in the discount rate has been due to higher than expected growth in earnings. And so the numerator of any discounted cash flow analysis is growing more than the denominator is causing the present value to shrink. And that's how you get jaws to open like this. And so it's not people point out at the divergence between stock and bond returns and focus on the discount rate. And I think what they're missing very simply is the earnings expectations. Now, that doesn't mean it lasts forever. And in particular, earnings expectations for 2024 and 2025, analyst consensus are for 12% annualized growth year over year for 2 years. Now, I think that's extraordinarily optimistic and will only just support the existing jaws. And for the jaws to expand even wider, you'd have to have higher than expected growth than that, which is already very optimistic. So I'm very bearish on equities for that reason. But it's not, people then translate that into something called equity risk premium, which appears very, very low. And that's because they don't do a good job in isolating growth from equity risk premium. And so equity risk premiums have almost certainly expanded as bond term premiums have gone from deeply negative in the summer to modestly positive today. But the earnings continue to be very well forecasted to grow rapidly. And that's the demand that destruction playing through, that there hasn't been adequate demand destruction. So that's what I think is the principal driver for why, whether you use CAPE as your numerator or whatever equity discount model you use, that people are getting short equities prematurely because they're missing the high nominal GDP factor. And what I think I missed is that bond term premiums and like equity term premiums stripped of the growth factor fell rapidly in the first half of the year because of this lack of issuance, and that's now in the process of reversing. I'll answer your industry question with, that's really not my lane.
Mm. So, Mike, do you have any thoughts about that before we move it to the second hour? And specifically, I think what Andy's referring to in terms of the industry question is what parts of the economy are most exposed to credit refinancing costs? In other words, which areas or sectors have not locked in those long-term financing costs? Like we talked about, for example, the U.S. government issuing shorter-term paper as opposed to longer-term paper. What areas in the economy might be exposed in that way, and therefore making them more sensitive to the higher rate environment?
Well, I mean, I think the components that are showing extreme sensitivity would be the areas that you would expect, right? So new home sales, or home sales in particular, you're continually facing a refinancing. Every new buyer that comes into the market has to actually face today's rate, right? That can change. There are ways that can be modified if you allow transferable mortgages, for example, so that you don't have to immediately pay back your mortgage. It's tied to the individual as compared to the property. That could be changed. We may actually end up seeing some of those rules flexed, and there is some flexibility around that from the government side. But that would be a perfect example, right? And that segment of the economy in terms of new activity, existing home sales being sold, allowing people to relocate for jobs, allowing people to move into their retirement planning, et cetera, that's just come to a dead stop, right? I mean, we can talk about the home building segment being relatively robust, but that's because all of the activity, and even that's beginning to slow now markedly, is in the new home segment where people are basically saying, I need to buy a house, I've got a kid on the way, I've got to continue my life, I am a buyer at almost any price. We're seeing those choices be made, right? But on the flip side of it, the actual process of people liquefying real estate value, et cetera, that's just come to a dead stop. That would be the most obvious one. Other areas where we're starting to see a play through is in the auto sector, right? So we're seeing a market deterioration in terms of autos, and in particular, the level of sales of autos and leasing activity of autos in the economy. Those would be areas that I would point to and say that we're seeing very, very clear evidence that is being hammered. Commercial real estate is obviously another one where the financing is relatively short dated, et cetera. So those are all things that are playing through, I think, in a relatively important way. Again, the relative lags associated with it because we had so many delays and because we had such a high level of activity that was effectively built into a slow-moving system, particularly around multifamily construction, I think that's delayed some of the impact that we would have seen. But again, like Go back to 2005, right? Remember, that is when the housing market peaked. The impact of the hurricane spiking oil prices in the summer of 2005, or more accurately, gasoline prices, suddenly made it completely uneconomic to continue the behavior that had actually happened prior to the global financial crisis, which is people moving further and further away from their jobs in order to gain access to housing, right? That spike in energy prices began a slow collapse that didn't manifest itself. And today we still confuse the dynamics of the housing market collapse, which was basically done by 2007, right? We'd actually seen the Big Short largely play out at that point. We confused that with the events of 2008, which was, much more a function of a breakdown in the financing across the financial system. So we're watching a similar slow play. That's part of the reason why I brought that analogy up earlier on. Like, we've seen this game played before, right? The difference then is that commercial paper played a much larger role. It hit faster. Now we're seeing that process move much more slowly, and we're seeing all sorts of shenanigans. I would point to things like NAV loans or GP commitment loans that are happening in private equity that are ways they can further lever up, even at extremely high rates, to preserve the optionality of holding on to their position today, right? But all of this is a slow-moving train wreck, is I guess the easiest way to put it.
So I'm going to move to the second hour, guys. I want to ask some more pointed questions that I think are on investors' minds. For example, one of the things I want to ask you guys about is, what would you tell an investor who's looking at what's going on in the bond market right now and who wants to understand whether or not it makes sense on a risk-reward basis to buy longer duration bonds? Or, for example, what the risk-reward looks like for bonds that are closer to the front end of the belly of the curve, like 2 or 5 year duration bonds. There's also this brings us into a series of scenarios that we can consider for further steepening. How high could rates go over what period of time? Further inversion scenarios, things that could happen that could cause an unforeseen steepening. For example, things that could cause, some kind of exogenous event that makes people think that U.S. budget deficits are going to have to go much higher, that debt's going to have to go much higher. Are the Fed's hands tied here? This is another thing that a lot of people have been asking themselves about. And I could go on and on. For anyone new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Andy and Michael, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers gain access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Guys, stick around. We're going to move the rest of our conversation onto the premium feed. If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.